studying your last two. I swim med when turned in. The styrene down to mute. And can learn the pole that sunk he died.
Now that we understand the different income pools inside a corporation, the next step is understanding where that income is reported inside the T2 corporate tax return. This slide provides the big picture overview of how investment income flows from the corporation's accounting records into the various T2 schedules and ultimately into the final tax return. Let's start on the left side. Every corporate tax return begins with the financial statements. Unlike personal tax returns, where taxpayers often enter information directly from T-slips, corporate tax returns are built from accounting records and financial statements. This is one of the most important mindset shifts when moving from T1 tax preparation to T2 tax preparation. The financial statements summarize all sources of income earned by the corporation. These sources may include interest income, rental income, capital gains, Canadian dividends, and foreign income. Once the income has been identified, the next step is classification. Different types of investment income must be sorted into the appropriate income pools. Most passive income, such as interest, rental income, foreign income, and taxable capital gains, will flow into the investment income pool. Canadian dividends are tracked separately because they are subject to their own unique tax rules. After classification, the information moves into the T2 schedules. These schedules are the working papers that perform the detailed tax calculations. Schedule 6 is used to report capital gains and determine the taxable portion of those gains. Schedule 7 acts as the central hub for investment income reporting and calculations. It brings together information from various sources and is responsible for important calculations such as aggregate investment income and adjusted aggregate investment income. Schedule 3 handles dividend reporting and calculates Part 4 tax on Canadian dividends. And Schedule 53 tracks the General Rate Income Pool, or GRIP, which helps determine a corporation's ability to pay eligible dividends. Once these schedules are completed, the information flows into the final T2 return. The T2 return then uses all of these calculations to determine taxable income, corporate tax payable, refundable taxes, and other key tax attributes. At the bottom of the slide, you'll see the golden rule for investment income reporting. The process always follows the same sequence: financial statements, then schedules, then tax calculation, and finally, the T2 return. The key takeaway from this slide is that investment income reporting is not about entering slips or isolated numbers. It is about understanding the flow of information through the corporate tax system. Once you understand this roadmap, the individual schedules become much easier to understand and complete. Now that we've seen the big picture flow of investment income through a T2 return, let's take a closer look at the 4 key schedules that every tax preparer must understand. Think of these schedules as specialized tools. Each one has a specific job, but none of them work in isolation. Together, they form the backbone of investment income reporting in a corporate tax return. Let's start with Schedule 6 on the left. Schedule 6 is responsible for reporting capital gains and capital losses. Whenever a corporation sells investments such as shares, securities, or other capital property, the details are reported here. Schedule 6 records information such as the proceeds of disposition, the adjusted cost base, and the resulting gain or loss. Most importantly, it determines the taxable capital gain that will eventually flow into the corporate tax calculation. A useful way to think about Schedule 6 is this: investment sale goes into Schedule 6, and taxable capital gain comes out. Next, we move to Schedule 7, located in the center of the slide. This is the most important schedule in the entire investment income reporting process. Schedule 7 is the central hub. It collects information from multiple sources and brings everything together. Schedule 7 handles interest income, rental income, foreign income, and taxable capital gains received from Schedule 6. It also performs critical calculations such as aggregate investment income, often called AII, and adjusted aggregate investment income, or AAII. These calculations are extremely important because they can affect a corporation's eligibility for the small business deduction. If you remember only one thing from this slide, remember this: Schedule 7 is the control center of investment income reporting. Now let's move to Schedule 3. Schedule 3 is the dividend engine of the T2 return. Its primary role is to report dividends received and dividends paid. When a corporation receives dividends from another Canadian corporation, those dividends are reported here. Schedule 3 is also responsible for calculating Part 4 tax, which is the refundable tax associated with many inter-corporate dividends. After the calculations are completed, the relevant information flows into Schedule 7 and ultimately into the T2 return. Finally, we arrive at Schedule 53. Schedule 53 tracks the general rate income pool, commonly known as GRIP. GRIP is important because it helps determine how much eligible dividend a corporation can pay to its shareholders. You can think of Schedule 53 as a dividend capacity tracker. It measures and monitors the corporation's ability to distribute eligible dividends under the corporate tax system. Now look at the relationship diagram at the bottom of the slide. Notice that information flows between schedules. Schedule 6 feeds taxable capital gains into Schedule 7. Schedule 3 provides dividend-related information that supports Schedule 7 and other tax calculations. Schedule 53 tracks dividend capacity based on information generated elsewhere in the return. This is why no schedule works alone. Every schedule supports another schedule. Every calculation depends on accurate inputs. And understanding how these schedules connect is what separates simply entering data from truly understanding corporate tax preparation. The key takeaway from this slide is simple. Schedule 6 handles capital gains. Schedule 3 handles dividends. Schedule 53 tracks GRIP. And Schedule 7 acts as the central hub that brings investment income together for the final tax calculation. Master these 4 schedules, and you've mastered the foundation of investment income reporting in a T2 return. Now that we understand the major schedules involved in investment income reporting, let's walk through a practical example and see how everything connects together inside a T2 return. In this example, a corporation earns 3 types of investment income during the year: $20,000 of interest income, a $15,000 capital gain, and $10,000 of Canadian dividends. These amounts appear first in the corporation's financial statements, which are always the starting point for corporate tax preparation. Think of the financial statements as the foundation of the entire return. Once the income has been identified, we begin working through the schedules. Let's start with the capital gain. The $15,000 capital gain is reported in Schedule 6. Schedule 6 calculates the taxable capital gain. Because only 50% of a capital gain is taxable in Canada, the taxable capital gain becomes $7,500. That taxable amount is then transferred into Schedule 7. Next, we move to Schedule 7, which serves as the investment income hub. Schedule 7 combines the corporation's interest income with the taxable capital gain received from Schedule 6. In our example, Schedule 7 receives $20,000 of interest income and $7,500 of taxable capital gains. Together, these amounts create aggregate investment income, or AII, of $27,500. Schedule 7 is also responsible for calculations that may affect the small business deduction through concepts such as adjusted aggregate investment income, often called AII. Now let's look at the dividend income. The $10,000 of Canadian dividends is reported in Schedule 3. Schedule 3 calculates Part 4 tax, which is the refundable tax associated with many inter-corporate dividends. The dividend information and the related tax calculations are then incorporated into the overall tax reporting process. Next, we arrive at Schedule 53. Schedule 53 tracks the corporation's general rate income pool, or GRIP. This schedule helps determine how much eligible dividend the corporation may pay to its shareholders in the future. You can think of Schedule 53 as a tracking system for dividend-paying capacity. Once all of these schedules have been completed, the information flows into the final T2 return. The T2 return combines all of the calculations and determines the corporation's taxable income, tax payable, refundable taxes, and other important tax attributes. Notice the common mistakes shown on the right side of the slide. Many beginners try to enter T-slips directly into a corporate return. Others skip Schedule 7, forget Schedule 6 when reporting capital gains, or fail to understand how information moves between schedules. These mistakes can lead to inaccurate tax calculations and filing errors. At the bottom of the slide, you'll see the mental model that professional tax preparers follow. Start with the financial statements. Break the income into the correct pools. Use the appropriate schedules. Calculate the tax consequences. And finally, review the completed T2 return. The key takeaway from this example is that every type of investment income follows a specific path through the corporate tax system. When you understand how information flows from the financial statements through Schedules 6, 7, 3, and 53, and finally into the T2 return, you move beyond simply entering numbers and begin thinking like a professional corporate tax preparer.